Here's what's coming up on today's show.
So I think it's important, regardless of the interest rate regime or the headlines, it's kind of a similar story that you want to put together an investment strategy that contemplates all those different risks.
This is the Retire Happy podcast with John Amarino, a fiduciary financial advisor at Securus Financial in the San Diego area, and Thomas O'Connell, president of International Financial Advisory Group, Inc. in Parsippany, New Jersey. Together, they'll be keeping retirement happy from coast to coast.
Welcome back to another episode of the Retire Happy podcast. I'm your host on the West Coast, John Amarino, and I am joined by my esteemed co-host and great friend, Tom O'Connell on the East Coast. Tommy, how you doing, buddy?
Happy New Year. Happy New Year. It's been a few weeks since we've last chatted, and I hope you and your family had a great holiday, and all our listeners as well.
Yeah, it was a great Christmas, great New Year's, and I'm the only survivor of the flu, so didn't get hit with the flu, but everywhere we've been, it's been killing us.
Well, I'm glad you're okay.
So that means a lot, Tom. So, folks, 2024, a new year, and more new market predictions, right, Tom? You can hear them everywhere from this is going to be a boom year because it's a presidential election cycle to the foremost naysayer, Harry Dent, saying crash of a lifetime. So as we do with every year, we're starting January with one of two Brookstone superstars, the chief investment officer and the smartest and funniest guy, because he's going to probably smile at that, the funniest guy in the room, Mark DiOrio. And Mark has been the chief investment officer at Brookstone for better half of a decade and is just a brilliant mind. So without further ado, I'd like to introduce our guest, the chief investment officer of Brookstone Capital Management, Mark DiOrio.
And introducing the Chief Investment Officer of Brookstone Capital Management, Mark DiOrio.
Well, thanks, guys. That's quite an introduction, and I appreciate being able to join the hottest podcast in investment management, sweeping the nation. So this is great. I appreciate it.
Wow, we're glad to have you.
Warm and funny. You are the funniest guy in the room, though, Mark. Come on.
And who said economists don't have a sense of humor? Come on now.
Well, after the last few years, you really have to have one.
So, Mark, it's 2024, and as we always do, we bring you out here to give your put your Karnak hat on, the old Johnny Carson, and give your market guru predictions. So, 2024, it's a presidential year. A lot of people are still concerned about recessions. You have the Harry Dents of the world saying a crash of a lifetime. We have interest rates. We have World War III on the brink. All the fear mongering that's going on. So what say you?
I would say that is one of the greatest challenges for investors in 2024, which is very heavy headline driven, emotional driven type of marketplace. But I would have to separate those headlines and those emotions from an investment strategy and how the market performs. Oftentimes they are disconnected, and sometimes the market will rally even when you think things aren't as good as they are or could be. Some things are dour. And I think a good reflection of that is at the end of 2022, most of the prognostications and the predictions coming out of Wall Street were very negative. We'd turn the page into 2023 and we'd enter a recession immediately. Our view, and what we talked about last year, was that we thought the recession was pushed out and the market was oversold, which would allow it to basically have kind of this surprise relief rally when a recession doesn't occur. And so we think the recession continues to be pushed out, if you will, and there isn't a recession yet. And so the market has climbed this wall of worry in 2023. And then going back to election years, and you made that comment of what people think, we went back to 1950 and looked at how election years performed relative to regular years. And they underperform the average year, but they are still positive, where you have kind of a flattish first half. And then as you identify who the candidates are, you get a little bit of a nervous movement in the third quarter. But then after the election, there's a relief rally that actually drives the market higher, and then into that first year of the presidential cycle. So I wouldn't overestimate any significant news headline from week to week. There's going to be a lot of them. I don't remember the headline from 3 weeks ago or 9 weeks ago. It's more, and we'll have that again in 2024, just heavy headline driven, hard to know where the economy is going. So I'd take a step back and make sure you have a sound investment strategy and thought this through ahead of time, and built a portfolio contemplating your expectations, your risk and return levels, and really your overall risk tolerance. And I know you guys go over that with your clients week in and week out.
So what are some of the major market indicators you're going to be looking at going forward in the short term, maybe for the next coming quarter, 6 months, 9 months, that are going to help you drive your decision-making process in the portfolio build-outs for people?
So a real blunt indicator is the interest rate regime, whether the Federal Reserve is raising or lowering interest rates. So we've just gone through about 18 months where the Fed was on an aggressive interest rate raising campaign, bringing the interest rates from essentially 0 up to 5.5%. Well, that's the major headwind for the markets. Cost of borrowing money is getting more expensive. And what they were trying to do was reduce inflation. So as they're raising those interest rates, they're trying to slow down the economy because the inflation genie got out of the bottle. And so they didn't want inflation, which is a general rise in prices, to keep going and have expectations for inflation get out of hand. They wanted to get that inflation down. Typically, the way you do that is slow down the economy, slow down demand, and get supply back into alignment. And so we've seen inflation come back down. And it looks like to us that the Fed is done raising rates, and we expect them to start lowering rates in 2024. Now, I don't know, I should say, I think that Wall Street expectations are a bit aggressive. They think that the Fed will reduce interest rates 6 times this year, a quarter point each time, so down 1.5%. We would put the odds closer to maybe 3 interest rate cuts. And the reason they would cut is because they look at it as, well, we're already restrictive. If we get inflation back down to the 2% level, we don't want to be overly restrictive and really push us into a recession. And so I think that's what they're looking at. So if you have a Fed policy not being hostile to assets and the economy holding up, and I think that's the surprise to people, that the economy has held up relatively well in the face of really raising interest rates and inflation. And the reason it's held up well is because the jobs market has been very strong. You've had unemployment below 5% and below 4% for an extended period of time, allowing kind of the consumer to navigate the inflation that we've incurred. And I have one rule, since I've really been doing this over 20 years, and you'd say the one rule is never underestimate the U.S. consumer. They are very resilient, and they come time and time again. That plays out where the consumer remains strong, and the consumer is important because they're 70% of the economy, GDP growth.
Now, you mentioned, inflation potentially interest rates potentially going down. Over the last couple of years, we've seen a flee to money markets and the safe cash. Oh, we can get 5% of our cash. We don't want to be involved in the markets. What are your feelings on being too heavily invested in cash, and especially in a decreasing interest rate environment?
The reason you build an investment portfolio is to preserve your purchasing power and grow that purchasing power over time. And so saving in cash is really for short duration. It's not really an investment strategy that's going to preserve your purchasing power over time. So while you may think, and we talk about the volatility in the markets from week to week, month to month, day to day, it's really inflation that can really eat away at your purchasing power more so than volatility. So volatility is a short-term risk. Inflation is the longer-term risk. And so if you're essentially moving into cash and staying in cash because you like that stability, now you're getting a little bit more interest than you had been previously. That's really a short-term. You've really made a trade-off between short-term and long-term, meaning you've reduced your short-term risk, but you've extended or increased your longer-term risk, which is the bigger risk. historically stocks have outperformed cash equivalents on any one year about 88% of the time. And you go out to 10 years, it's 100% of the time. There's something called the equity risk premium that Professor Jeremy Siegel out of the Wharton School has done a lot of research on, couple hundred years of research that just says consistently investors get on average a 6 to 7% investment return above cash equivalents, depending for a longer period of time. So in other words, you're missing out on a lot of gains that accrue over time. And so the cash equivalents and money markets, even though they're yielding a little bit higher in interest, that's really that short term. They were really just matching about the average inflation over that time, so you weren't gaining anything. And now that they're reducing rates, remember what happened last time when they reduced rates. If your strategy was to save in CDs or bank savings accounts up until 2007, you're earning maybe 5%, close to what you might be now. All of a sudden, you went to about 0 to 1% for 10 years. And so that can happen where you have lower interest. And then what do? What if the market has moved even higher, started to rally because of those lower interest rates? Now you'd be buying in at a high. So I think it's important, regardless of the interest rate regime or the headlines, it's kind of a similar story that you want to put together an investment strategy that contemplates all those different risks.
So that part of that strategy is going to include what we call fixed income assets, which is, I guess, maybe one step above the money market CD type of programs. And if, as you're predicting, we see, and as many people are predicting, we start seeing interest rate cuts after the last year or 2 years of really, I guess, a bond rally in that sense of interest rates going up, being able to secure higher interest returns. What do you see the bond market doing if they do start cutting those rates?
So this is an interesting situation where we've had what's called an inverted yield curve. Now, before you turn off, I'll explain what that is. It's where short-term rates are higher than long-term rates. And this is normally if you put your money into a longer-term bond or CD or investment, you'd expect a higher interest rate. Well, right now, the 10-year Treasury, the Treasury is what the government issues to pay its bills and so forth, can issue 10-year paper at 4% interest. So a 10-year investment bond is paying a Treasury bond is at 4%. You could invest in a 3-month Treasury, and that pays about 5.5%. So big difference, and it's been an extended period of time where you've had this inversion. So when we say that they're going to reduce interest rates, that's the Federal Reserve, that's the central bank of the U.S., they decide to raise or lower the short-term interest rate, technically the federal funds rate, which is the rate that banks charge each other in the overnight market. It's normal for banks to say we have excess cash, another bank lent some money out and just has to keep regulatory reserves on hand. So this is a normal functioning market. It's not that a problem with the banking system. So they determine those rates that you charge overnight. And that really lends itself to what you charge, what the banks charge for loans to make sure that they can make money on their loans and have a net interest margin, where the treasuries are what the government issues at. So that longer duration is dependent on the marketplace. And what's unique about this environment in particular is this difference, which is, well, the Fed may lower interest rates, but the longer term rates may actually go higher. And so you really have to think this through in terms of we have a lot of debt. They're going to come out, and the more that they deficit spend, they're going to have to issue more and more Treasury bonds out there. So you can really have two different types of bond markets where short-term rates are reducing, longer-term rates are rising. And for bond investors in particular, if interest rates are rising, bond prices are declining. So that can lead to losses in what you'd otherwise concern as your kind of your conservative portion of the portfolio. But I think that lends to the benefit of what you're talking about with some of the fixed income instruments that you're talking about, Tom.
So an inverted yield curve, as we've been taught for many, many years, typically is a signal or a sign of a coming recession. But what you're saying is, although there is an inverted yield curve currently, the expectation is that those longer term rates are going to go higher, which will re-invert, or I'm not sure the correct uninvert, right? Which is maybe more of a sign that we're past a recession, or the fears, or should be past the fears of a recession.
Not necessarily. So I wouldn't give this signal as much credence because rates were held artificially low for a long period of time. You had COVID era policies going on, and then they had to raise rates very quickly for the market to kind of keep up. So I think that signal was a little bit less this year. It is historically, you're correct, been almost 100% indicator of recession over the last 9 recessions or whatever, that you have this condition, which is true, which is still a risk out there, that we still have this condition and it can lead to recession. That's why we don't take it off the table. We'd say there's probably about a 30% chance of recession at the back half of the year. So that's non-trivial. That's not the base case, but that's still an elevated percent of recession, since we only go into recession 8 to 12% of the time, and you have it a little bit higher now because of this inverted yield curve situation. That's really signaling something's off with the kind of the duration and matching of assets and liabilities.
Now, Mark, I'll throw a curveball at you because you mentioned the debt, and we all know that the U.S. government, a lot of their debt's bought out by other countries. A couple things that have kind of come across, my readings are, with the development of the BRICS and the impact it could have on, essentially really hurting the U.S. dollar going forward. What's your thoughts on that?
So the U.S. dollar is actually overvalued on a purchasing power parity basis. And we'd expect the U.S. dollar to start to decline or depreciate in value. This is another reason why you'd have an investment portfolio, because the value of the dollar is ultimately going to decline. It has been declining. That's what inflation is. How much it declines is on a relative basis to other foreign currencies, but also based on inflation are the cost of goods and services that go up or down, mostly up, of course. So meaning the dollar is going down in value. I do not think that they're a serious threat. The dollar still dominates in terms of global trade. The dollar is what's most wanted. Those countries don't even trust each other for the most part. But it's not to say that that's not needed, because we're in a different type of world. And I think that's clear, where you do have different trading relationships, partnerships. It used to be that oil was traded only in dollars and only settled in dollars. Now we see that trade not necessarily being settled in US dollars. I think what the difference is you have the dollar, and then you have some of these other forms of settlement, if you will. So maybe it's gold for oil, for example, in these different pairs, and maybe they just use a currency because it makes it easier than obviously shipping gold from one spot to the other. That's heavy, and security and so forth and so on. So I think that's going to be a continuing theme, but I wouldn't overplay the demise of the dollar. I think it's going to come down in terms of purchasing power parity. And I think it's going to come down for a few years relative to other currencies. And again, that is actually supportive of investment assets. And so I think that just kind of gives you another reason to be an investor, because that versus just staying in cash, for example, because the purchasing power of the dollar is going to continue to depreciate.
So I'm going to go off course just a slight bit, since you mentioned gold, and maybe we can talk about gold, silver, and maybe commodities in general a little bit. We've seen gold and silver hit highs that they haven't reached in a long time. They seem to have stabilized. The gold has seemed to stabilize over the $2,000 an ounce mark. Silver over the $24 an ounce mark. What do you see there? Is that something people should be paying attention to, or is this just a blip in the market in there?
Gold has been an excellent diversifier to traditional stocks and bonds. So when added to a portfolio, I do think it adds value. It marches to its own drummer. It can diversify both stocks and bonds, have its own kind of risk and return stream. And in this environment in particular, we do see some of the foreign central banks accumulating gold, so being buyers of gold. So whether that's Russia, China, whoever, adding to their gold reserves. So this is just a central bank adding to their reserves, where they do own U.S. treasuries, but gold has been a little bit more popular. So I would say it might come back into favor, especially if the dollar is declining. It is a beneficiary. Gold, for example, is a beneficiary historically if the dollar's declining in terms of purchasing power. Silver is similar. It's about 3 times as volatile as gold usually. So that's just a little different animal. It has more industrial use versus gold. Gold has a little bit more traditional statistics from an investment portfolio perspective. And I would separate that from something like oil, for example, which is more economic related versus kind of financial related, where gold would be. And oil, interestingly enough, is down in the 70s, despite kind of the escalation in global wars. And when Russia invaded Ukraine, we thought we'd be at 120 oil, and that was kind of the consensus. But we've seen that come all the way down. A lot of that has to do with the U.S. producers and shale. So we say at the moment, oil's kind of come down. Energy stocks have kind of been so-so, but that's a theme we'd go back to in the not too distant future once this kind of downturn has played out, because we don't think the increase is sustainable, and there's kind of been policies put in place to kind of keep production below where it could be.
Right. So we talked about gold, we've talked about cash. Now the routine, or the ever popular keeping up with the Joneses, the S&P 500 and the Dow, right? Everybody wants to chase those ticker symbols, even though they say they don't want to. Human nature, the fear and the greed part, we want those highs, and the fear, we don't want those lows. So let's talk about, and this has really kind of been the mantra for a couple of years, the overconcentration of performance of the S&P 500. What's your hypothesis on that?
So we've had a big run up in terms of the large mega cap stocks. And up until about 2001-ish, it's really been justified because their sales growth and earnings growth was growing in that magnitude. In this latest run up, after we had the decline in 2022, then the bounce back in 2023, their sales and revenue growth as a percent of the overall kind of the S&P 500, for example, of those stocks, did not keep up with the movement in the stock prices, meaning the stock prices went up and the sales growth really didn't justify it necessarily. Granted, these are top tier companies and they're going to remain relevant, but that concentration level in the top 10 stocks is now at a level we haven't seen in 50 years, since basically the mid 70s. And after that point in time, you started to see their share decline relative to kind of the stocks that all got left out of the rally of the mega cap stocks. So while those are important stocks, I think you'll find growth in other parts of the market to be much better over time. And so this will be a slow process, but it could, play out over a number of years. And that's what gives us a little bit of positive view of the market, meaning there's a lot of stocks that just haven't participated in the overall rally and are really below, are priced relatively below where they otherwise would be or have traded historically relative to the market, because there has been so much concentration of capital into those large tech stocks.
So you would say that maybe across the board for indices, right? There's really just kind of a pocket of a few that are carrying the load for everybody. So whether that's the S&P 500, the NASDAQ, the Russell, any of those indices, really, we're just seeing very few performers and the rest are just riding the coattails. Would that be a fair assessment?
Definitely. So I think most of last year, it was really those top 10 stocks were almost 90% of the entire return. So the other stocks really weren't pulling their weight or participating. It was just in those top stocks. And so that can happen from time to time. It just happens to be that we've seen these just grow and grow and grow and really dominate the marketplace. So that's a pretty rare event when that happens. And the flip side is that it's been growing, occurring for a number of years as they've been growing more and more in concentration. But there is a flip side. I mentioned we haven't seen this level of concentration in the top 10 since the mid 70s. And after that time, you started to see the rally broaden out, and those stocks didn't have the same pace of growth as other stocks in the market did.
Which is a great reason why you, as a chief investment officer at Brookstone, preach diversity, right? Based on the academic principles, be diverse, not just having an S&P 500 and a couple bonds in the Dow, but whether it's low vol, emerging markets, really kind of having that widespread net.
Well, definitely. So the market indexes, when we're talking about concentration, are market cap weighted, meaning the largest stocks represent the largest percent of that index. And right now we're looking at really an approach that says, why not an equal weighted approach to all those stocks? So maybe the stocks are, you have a stock basket, why not equal weight those stocks? So if you have 100 stocks, that's 1% in each of those stocks. A basket of 30 stocks, it's 3.33% in there, meaning you don't concentrate in any individual stock. You really broadly allow these different stocks to participate. And historically, that has actually outperformed the market cap weighted stocks. And I think we're in that right at the beginning of that transition phase where the market cap concentration was outperforming to now going back to where those equal weighted approaches and that more diversification starts to show some benefits for clients.
Do you feel that diversification and in combination with interest rates and other considerations, where does that fall, let's say, for the dividend yields from stocks and the income maybe that people are trying to get from those types of investments?
Sure. Dividend strategies and dividend stocks are very underappreciated, I like to say, especially for real world investors, right? And not just theoretical or academic research. Dividend stocks pay dividends or cash flow to investors regardless of the environment. In other words, no matter if the stock's going up or down, if they're a good company, they'll pay out the dividends. So you get, as a share owner, you get a share of the profits. And right now, those yields, and just to point on dividends are determined by the board of directors of the company. They're not determined by the market. And so that board of directors determines the dividend payout. Usually they determine for a year, and then the following year, they decide for the best dividend companies whether to raise that dividend in dollar terms to shareholders or not. And some of the best dividend companies have paid for 40, 50 consecutive years, rising dividends to their investors, meaning they make a profit, they make more the next year, they're sharing more in dollar terms. That can really add up when you say your income coming from the stock that you own is rising at a rate faster than inflation. So you're getting raises at about double, historically it's been about double the pace inflation, or what typically you would get if you were an employee, for example. That's one of the benefits of being an investor, that your cash flow can increase organically over time. And so you get the two components, both the cash flow component from stock ownership and then the potential for price appreciation of the stock. And so I think right now you're getting about a 4% to 5% in a good, solid, high quality dividend strategy. And I think that's pretty attractive in today's world. And when you think about that, and why I said the good dividend companies raise their dividends, well, the dollar amount coming out next year could be more, and the year after more and more and more. So these high quality companies that you think they're brand names, but people sometimes tend to underappreciate what they do for shareholders because they're somewhat boring at this point, but they make quality products we all use on a regular basis and just have a repeatable business model. But they're never really in the news other than occasionally because they don't have the hot product or the hot tech, because that's not the type of companies they are. But they can definitely play a role both from capital appreciation perspective and also, importantly, in today's world, a cash flow perspective and growth of that cash flow over time.
Now, we talked about the S&P 500. We talked about some dividends, and I just really want to spend a couple minutes on some of the alternative type of nuanced investments that you guys have really rolled out that have really brought value to our portfolios. I mean, mainly, especially with the interest rate risk in 2022, is the buffered ETFs, and then a long hold with you guys, the structured note.
That's exactly the question I just wrote down. Seriously, I was just going to ask the exact same thing.
Well, I'll take buffered ETFs first.
All right.
Buffered ETFs are exchange traded funds. So they trade all day like a stock, but have a certain strategy in them. And so we've used a lot of ETFs because they've been an investment vehicle that's lowered cost to the end investor and also expanded the opportunity set. There's some interesting and innovative investment strategies inside an ETF. Well, buffered ETFs allow you to have participation in the S&P 500 or whichever index that you have, up to a certain cap over a 1-year period, but then they also buffer the certain percent of the downside, meaning you don't absorb a loss until you exceed that buffer level. So they come in a couple of different flavors. One it buffers the first 9% of the loss. Another version buffers the first 15% of the loss. And then another one does a -5 to a -35%, meaning you get the first 5, but then you're really hedged for the next 30%. That provides a pretty good layer of protection, but then also provides upside participation. Right now, we're seeing what we call caps in the 12, 14, 16% range. And you know this going in ahead of time. And us as investment advisors determine, well, is that a good trade-off? Is that reasonable? And to us, that upside cap is very reasonable for the level of downside protection that you get. So what this is doing is actually allowing you to participate in the equity markets at a lower volatility level. So this makes a lot of sense. So we found a lot of fits. And this is a good point where we spent a couple of years monitoring these investment vehicles, making sure they were doing what they proposed that they were going to do, and worked in real time. They were stress tested in 2020 with the COVID pandemic and extreme market conditions, and worked just as we expected. So we're gained a lot of confidence over that time period, and then started to implement them more and more broadly. And then the other component is structured notes. So structured notes are a financial instrument issued by the capital markets desks of some of these large major banks. So a lot of investors really haven't had participation in these or even heard of these necessarily. But we go out and we negotiate with the capital markets desks of the banks. So whether that's JP Morgan, Bank of America, Goldman Sachs, they all have these desks in New York. But they package these investments and then send them out to the financial community. We negotiate a custom note that we call a flash note. It's an income-based note that has consistent terms, and we do this every month. And we go out to each of the different houses and they bid on the terms. So you look at who the issuer is, what the term is. Since it's a note, the term is a 1-year note. What's your payment proposition? So this comes in the form of a coupon. Typically, we've seen coupons in the 8 to 12% range. Some have been higher than that during certain periods, but it's above average coupon is the point. And each month it can differ, but again, you know ahead of time. And then fourth, what's the downside protection levels? What's the trade-off? It's a note. It's not a bond. It's a structured investment vehicle. And what they say is your principal is guaranteed to be repaid at par value up to a 30% decline in any one of 3 indexes. So the S&P, the NASDAQ, and the Russell. So common indexes. In other words, you know your layers of protection. So they're pretty good. That 30% decline is pretty steep. So these are very unique. And what we do is build a strategy around that where you just don't own one note for 1 year. You'd say, well, I have a sleeve of my portfolio, 10, 20%, whatever is the appropriate percent. And then I ladder these notes. So I'd put a percent in January, February, March, and then each note has its own unique 12-month series. And then you get the average of the income payments, and they pay out on a monthly basis. So it's really a unique strategy to add to a portfolio with those layers of protection and that above average coupon.
So John and I have used these for a long time through Brookstone, and as have many of the Brookstone advisors around the country. Now, I think one of the more unique things that you guys are offering is more of a kind of like an ETF of structured notes now. Something where, as opposed to just having an individual issue, there's a pool that people or investors can get into. How is that different than just getting the individual, and what do you see the benefit of that?
Well, I think the main benefit is we put that strategy around that and made it easy to allocate to and kind of automated that system. Whereas before it was a little bit more of a manual process for sure. The notes would come out every month. When we negotiated them, we'd let investors know. And then by hand, you kind of have to look at, okay, I have the X percent of the portfolio I want to put in this note. Here, we've allowed it to automate that situation where you'd say, okay, I want to ladder over the next 6 months, and here's how we're going to ladder it. And then once something matures, we'd reinvest that automatically for you and sweep in the cash. And so you have a little bit higher allocation next. So I think it just put it into a real advisor and investment friendly sleeve of the portfolio, if you will.
And we don't see this across the board in other RIAs or brokerage houses, or this is not something that's common in the investment world. Would you agree with that?
I would definitely agree with that. I think we spent a lot of time kind of researching this and the application. In fact, we wrote an industry-leading white paper on this a number of years ago. And the reason we did was because we couldn't find it in the industry. We heard all these couple of comments about this or that, but no one really put it together in the kind of the advisory world of how you use these notes. What are the pros and cons? Like any investment, you weigh the trade-offs. What are the pros, the cons, and determine what the appropriate allocation is for the different types of clients. Well, we saw this is no different, but we saw a great lack of information available. And so we tried to put this together so that it would be, here's kind of a reference piece behind this, and here's our experience with these. And we've been doing these every month for the last 8 years. And so we have great data. And as you're mentioning, we think we have, or at least I'll add on to what you're mentioning, we think we have the best data around this investment structure because we've been doing it so long with live dollars. And we also negotiate and think we get the best terms because we're one of the largest, if not the largest buyer in the marketplace.
These alternative investments have made a huge difference in our clients, both in positive and downturns, because how many of these notes have actually triggered? I mean, we've had these, I think we're going on 7-8 years, Tommy, probably investing in these. How many notes just in the last 5 years have actually triggered?
I would say less than a handful.
That's about the correct number. And so we expect them to, occasionally the market drops below 30%, but all that happens is you continue to get your coupon and then you get the value, whatever the end of the note is. And so if you ladder it, and you mentioned just a handful, it can happen. But going back to really your comment, John, on good and bad markets, in 2022, both stocks and bonds declined double digits. Well, a ladder of these notes were not really impacted by the rise in interest rates, which created the decline in bond values, and then also created a bear market in stocks dropping over 20% during the year. These kept paying their coupon, and then you had that 30% barrier before it got breached. So it provided its own risk and return stream laddered over that time period.
That 30% downside is a big number to have to fall through at any given point in time. And as you've stressed here, you don't put them all in just one note. You don't put all your money in one note. You're putting it. You could have, if you're doing it over a year's time, you could actually have 12 different anniversaries.
Definitely. So there's a lot of flexibility in how you apply these notes as well during different market environments. And so this is also one of the areas where if we see a lot of volatility in markets, or if the market's declining, you actually get a bigger coupon. And so this is the first area we look to for opportunity when we see a declining market. What's the coupon? Because during COVID, you were well into the teens for the coupon over a 1-year period. And I think that makes declines look a lot different when you're looking for opportunities to take advantage of during market declines than just being worried about that the market's declining because of a various either narrative or what happens externally to the marketplace. When you're saying, I'm an investor, now I'm looking for opportunities, the market presents some at differing time periods.
Yeah, those 13, 14, 15% interest numbers were nice to be able to throw around like you were saying, when everybody else was at a 0 or a 1, or we had a downturn in the marketplace. So being able to say we got that for a client was great.
Definitely.
And again, it goes, you've said a lot. Investing, especially in retirement, it's not about a 1, 3, or 5 year return. It's a 20, 30 year time horizon. And, the core satellite approach, diversification, having these notes, having these buffered ETFs, we're not trying to reach the peaks. We're trying to avoid the valleys, and we're trying to just kind of ride the middle of that wave. And, that's the big thing, because when you're invested in the market and you have a team like we have with Brookstone, we're getting opportunities in the down markets. And not only do we have the opportunities, but we haven't lost our butts like a lot of the people that are just chasing those S&P 500 returns. So those opportunities have a little bit more power behind them.
Yeah, you're gonna make more money by limiting your downside than, like you're saying, John, than trying to capture the ultimate highs of the market. Because when you're trying to capture that, you're also capturing the worst of the lows too. And so trying to even out that curve, so to speak, in the long term, people are going to end up with more money in their pocket.
Yeah. Well, folks, that was the Chief Investment Officer, the smartest and funniest guy in the room, Mark DiOrio. Mark, I know I can speak definitely on Tommy's behalf, as we're lifers of Brookstone Capital Management. There's not a investment firm out there that could pry us away from the company that Dean and Derek and you and Daryl have all been behind. And we thank you for all your thoughtfulness and really the clients, putting the clients first, and caring about our clients. So we thank you for all your hard work, and we're definitely appreciative of it.
Well, thank you guys. I really appreciate being here, and would love to join you again sometime.
Well, you're always welcome here, Mark. You know that.
Yeah, I think we're gonna have to start getting you on right at the end of the second quarter. When things always get fun, maybe September, October, when people love the markets. So
fair enough.
Maybe, and then you can make your presidential predictions.
Oh, very good.
Well, folks, that was the Chief Investment Officer of Brookstone Capital Management, Mark DiOrio. We thank Mark again for everything. And he's, as I said in the beginning, he's part one of two investment or industry stars that we're starting the year off. So thanks again, Mark. And we will be in touch with everyone here in a couple weeks with our second star. So until then, folks, we want you to just stay warm if you're on the East Coast. If you're on the West Coast, well, we are warm. And enjoy your retirement, folks. Take care.
It's easy to get in touch with John and Thomas. If you're more on the West Coast, give John a call at 858-935-6210. That's 858-935-6210, or go online to GoSecurus.com. That's GoSecurus.com. If you're more of an East Coaster, then call Thomas, 973-394-0623. That's 973-394-0623, and online at internationalfinancial.com. That's internationalfinancial.com. And you can, of course, always just check the description or the show notes section of today's show for all that contact information. Don't forget to subscribe on your favorite podcasting apps, and we'll see you next time on the Retire Happy Podcast.
Investment advisory services offered through Brookstone Capital Management, LLC BCM, a registered investment advisor. BCM, Securus Financial, and International Financial Advisory Group are independent of each other. Insurance products and services are not offered through BCM, but are offered and sold through individually licensed and appointed agents. The opinions expressed by John Iamarino, Thomas O'Connell, and guests on this show are their own and are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. Investments involve risk and, unless otherwise stated, are not guaranteed. Past performance cannot be used as an indicator to determine future results. Any strategies mentioned may not be suitable for everyone. Information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for you. Before acting on any information mentioned, please consult with a qualified tax or investment advisor to determine if it is suitable for your specific situation. This program is designed to provide accurate and authoritative information with regard to the subjects covered. Registered investment advisors and investment advisor representatives act as fiduciaries for all of our investment management clients. We have an obligation to act in the best interests of our clients and to make full disclosure of any conflicts of interest, if any exist. Please refer to our firm brochure, the ADV 2A Item 4, for additional information.
Structured notes involve risks not associated with an investment in ordinary debt securities. The securities are not bank deposits and are not insured by the Federal Deposit Insurance Corporation or any other governmental agency, nor are they obligations of or guaranteed by a bank. The securities will not be listed on any securities exchange, and secondary trading may be limited. Therefore, there may be little or no secondary market for the securities. Accordingly, you should be willing to hold your securities to maturity. The securities are subject to the credit risk of the issuing bank, and any actual or anticipated changes to its credit ratings or credit spreads may adversely affect the market value of the securities.